There is a specific kind of dread that kicks in when the house goes quiet. It's the lingering background anxiety of our money lives. We lie awake wondering if we're making the right decisions, or if we're somehow missing the wealth building train as it accelerates past us. When we face that unknown, the instinctual response is to freeze. We worry about medical emergencies, aging parents, and long-term care, so we just hoard cash in regular bank accounts, waiting for a clear signal on what to do next. And right when that cash starts accumulating, someone notices. A persistent, pushy financial salesperson, a sharpshooter, steps in. They throw complex numbers at you, applying pressure directly to those pain points of fear and guilt. Exhausted and wanting to do the responsible thing, you hand over your money. The result is almost always a bad investment, a heavy loss, or a confusing hybrid product that delivers returns worse than a standard bank deposit. If you have fallen into this trap, you need to know it is not a personal failing. You are operating in a toxic, predatory environment without a shield. The financial sector currently operates on a buyer beware model. This framework transfers the entire responsibility of technical due diligence from the multi-billion-dollar institution to the individual amateur, a structural failure in how the industry is regulated. Expecting an average person to calculate concepts like present value, future value, and real returns on the fly is absurd. It is exactly like a car salesman opening the hood of a vehicle, pointing at the raw engine components, and telling you to do your own due diligence to ensure the car is safe to drive. The jargon, the math, the sheer volume of options. This complexity is entirely intentional. The global financial sector profits directly from making you feel stupid. To survive this, we have to stop looking for the perfect, magical investment product to save us. There is no single-shot solution that cures financial anxiety. Instead of hunting for products, we need to build a defensive, mechanical system. The foundation of this system requires shifting how we view our earning years. We are going to treat your entire financial life as a simple money box. This diagram shows the basic mechanics of that concept. Your income acts as a steady stream of liquid pouring into the top of the box. Naturally, that liquid leaks out the sides to cover your living costs, rent, taxes, loan installments, and groceries. But each month, whatever survives those leaks pools at the bottom of the box as a clean surplus. Here is where the fatal error occurs. The moment people see that surplus, panic sets in. They assume this box is purely a container for investments, and they immediately try to convert that liquid cash into a plot of land, volatile shares, or complex pension plans. Asking, what should I invest in at this exact moment is a mistake. It is an illusion pushed by a commission-driven sales industry eager to lock up your loose cash. Before we even think about touching an investment, we have to properly engineer the box itself. And the first step is streamlining your daily cash flows so that surplus is steady and predictable. As the schematic updates, we install the second critical step, a reinforced safety net. This layer sits right over your surplus to catch you in the event of a severe shock, like a sudden job loss or a massive medical emergency. This safety net is built using insurance. But notice the function here. Insurance is strictly a tool for wealth preservation. Its job is to lock down your life. It is absolutely not a tool for wealth creation. Only after your cash flow is streamlined and your safety net is firmly in place do you have the structural stability to start asking what investment portfolio suits your actual needs. Strictly separating the function of protection for growth removes the emotional leverage salespeople use to pitch hybrid products. It allows you to evaluate any investment based on pure data rather than fear. Now, let's be entirely clear about the reality of this process. Building this architecture is not a get-rich-quick exercise. Calibrating your personal cash flows, setting up your defensive nets, and aligning your investments will take roughly 6 months of concentrated effort to construct properly. But the payoff for that effort is structural autonomy. Once the components lock into place, the system takes over, running smoothly on its own momentum. You no longer have to entertain pitches from persistent brokers, and you can comfortably ignore the frantic daily noise of the stock market. This system provides more than capital gains. It recovers the mental bandwidth consumed by financial uncertainty, effectively silencing the background noise of the market. The ultimate operational goal of the money box is a hands-free financial life. Once it is running, you should only need to open the hood to make minor tweaks, maybe twice a year. As a reliable byproduct of this efficiency, the surplus quietly does its job in the background, smoothly funding your children's education, paying for family vacations, and your eventual retirement, without the constant stress of active management. You step out of the role of the bewildered consumer and into the role of the architect. You understand the game, and you are no longer a target. Financial fitness comes from this shift toward engineering. By building a quiet, mechanical background system, you ensure that your money serves your life, rather than forcing your life to revolve around your money.